You're listening to UCW Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
Reason, for lack of a better word, is good.
You know what I mean?
Money to be made in a place like this.
Money never sleeps, pal.
You're crazy.
You know what it takes to sell real estate?
It takes brass.
I'm falling, and I can't get up.
All right, welcome to Money Never Sleeps, and the key phrase that's trending as we face the fiscal cliff is special dividend. That's right. It started out with Walmart trying to front-run the tax increases that will inevitably be coming up once 2013 rolls in. And that started the domino effect with companies such as Wynn Resorts following suit. This is just the beginning, I believe. And I expect a lot more dividend-paying companies to do shareholders a service by issuing these special dividends before the end of the year in lieu of the dividends that may have been paid out in January, February, March, because obviously, things are going to change. Now, sticking on the topic of taxes, come January 1st, 2013, by hook, by crook, by any which way you slice or dice it, there will be a new 3.8% tax on some investment income, which will include some real estate transactions. And now, just to clarify this will only directly impact those that have an adjustable gross income. I believe it's over $250,000. But that's all in, including salaries, dividends, interest, excluding munis, net cap gains, so on and so forth. So it's important that everyone educates themselves on these new tax laws and be in tune with what's going on with the fiscal cliff that we're facing, because at the end of the day, don't care what anyone says, this will impact every person in the United States of all classes. From entitlements to tax increases, from little I Joe to damned if I know, a lot of things are going to happen. Everyone will be impacted, bottom line. Now, with that said, I want you to join me in welcoming our guest for the first segment of Money Never Sleeps. And he is a commercial real estate professional with a vast knowledge in the area that will give us some insight on the potential impact that all of this will have on commercial real estate throughout the United States. So join me in welcome Michael Lagazzo to the show. Michael, welcome to the show.
Thank you, Lou. Thanks for having me on.
No, thanks for coming on. I know it was last minute, and I do appreciate you taking time to come on the show. Why don't you let our listeners know just a little bit about your background before we start going into it?
Certainly. I've got a background primarily in retail real estate, overseeing shopping centers for REITs like Westfield and Forest City. Most recently, I spent the last 2 years in receiverships working out a lot of the non-performing or distressed assets that have worked themselves out of the market for the most part.
Now, Michael, let me ask you something. Since you're primarily focused on retail, shopping centers, retail, commercial real estate. Now, have you seen a big change, as President Obama, was elected and we're facing the fiscal cliff? Have you seen a lot of things change in that sector?
Absolutely. With the anticipated $600 billion, or some estimates are as high as $718 billion in tax increases anticipated in just a few weeks in 2013, investors who are already risk-averse are looking for an attractive asset class. Folks have looked to commercial real estate for a less volatile yield than, say, the stock market. I think that's primarily affected. The high double-digit returns that you've seen over the past years are going to diminish to single-digit returns. You'll see a significant share of return coming from yield rather than appreciation, whereas in the past years you could almost anticipate appreciation of asset value.
Okay.
But overall, commercial real estate is still a good diversifier in a financial portfolio. You're just going to see slower building in terms of the yield and the value that those holdings generate.
Okay. Well, I mean, look, over the past, I'm not going to go far back. I'm going to say over the past 4 or 5 years, it's been like a monopoly game. People are shuffling, they're buying here, selling there, doing this, and so on and so forth. And do you think that part of it, all that activity, is going to come down to probably a drip?
Possibly. I understand that raising capital gains tax, for example, will have a direct effect on investor behavior. This last quarter, you've seen, or as many of you may have seen, an increase in disposition activity. A lot of private landlords, for example, wish to avoid the increase in capital gains and are selling off non-performing assets. You'll see larger institutions like Kimco Realty, for example, shedding a significant portion of their non-performing assets.
Mm-hmm. And that's something, I look at a company like Best Buy, and the reason I bring that up because you're in retail. Now, Best Buy, they own a lot of locations. They lease, but they own a lot of buildings. And as their business model actually they have to change because they're not doing that great. So they're going to have to restructure. So they as well will have some disposition action going on there to unload their when they shut down some stores, unloading their assets they really don't need anymore. So I mean that can actually have a negative impact as well. And if I'm wrong, please correct me.
Lou, I agree with you. You've got that existing inventory in place, as well as slower building, both in retail and office development. What you're seeing is a diminishing availability, which is artificially driving up rates. So going back to your question about seeing that slow down to a trickle, I believe so. I think with the potential increase in unemployment, that's going to affect your office leasing and sales. With lower household incomes, you're going to see a trickle in the retail development, retail leasing and sales. Hopefully that answers your question.
So you think it's not just going to be the sales part of it, it's also going to be the leasing part of it that's going to start slowing down?
I believe so. With less development in the marketplace, there's less competition for tenants. Competition is not being developed in the pipeline. So there's an urgency. The urgency that's driving any sort of positive absorption it favors the landlord.
Mm-hmm. And then I guess if you have commercial real estate owners, and at some point, I know over the past couple of years, they've been taking advantage of certain tax laws that were in place that allowed them to sell property and buy a like type of property somewhere else and avoid that getting slapped with taxes. And that's something that's going to change too.
Absolutely, which is why you're seeing a spike in this last quarter.
Right. So everyone's trying to front run before the end of the year, before they get stuck, and then come next year. I guess that anyone that shuffles around at that point, and if they see a profit, then they can actually get hit with a significant tax.
Absolutely. That directly affects capital flows into the market as well as valuations affected by cap gains hikes, meaning lower capital flows to real estate as an investment target make it less attractive. Smaller capital flows also will impact valuations. But to add on to that, all capital is affected, not just real estate, but capital that funds stocks, other securities. But ultimately, we'll see what happens with fiscal cliff, and it may be potentially good for real estate.
Okay. Well, I mean, it depends on what happens because, there has to be, they have to adjust the entitlements. They have to do something. Taxes are going to be increased. There's no way around it because they're going to do it, and because they need to generate revenue to fund the entitlements, which is crazy. But that's what they're doing now. And let me just kind of go down a different road, because I know come January 2013, that Mortgage Debt Relief Act, that's going to expire. And I know that impacts the residential market directly, but, I mean, if people have less money to shuffle around, that affects the economy. That can also affect, retail, commercial real estate as well. Because if people don't have money to buy, then the retail market, they're not selling as much, and that comes down to real estate.
I agree, especially with record low interest rates, like you said, with lenders, life insurance companies, and obviously institutional investors who are stricter about leveraging, despite the sort of balanced conditions of supply and demand. You're not seeing the deal activity that you would anticipate, but
so that basically this is going to wind up, hitting every portion of the commercial real estate market. I initially didn't really think that leases are going to be affected, but yeah, it kind of makes sense, because if people don't have the capital to go lease these retail spaces, then you're going to have building owners that own just straight commercial properties are going to start feeling the pinch. Absolutely.
Anecdotally, I anticipate a mild recession, even a short and shallow one. But you're going to see increases in vacancy rates, softening in rental rates.
Mm-hmm. Well, let me ask you this, because I know, like Walmart, I know they own a lot of real estate, but they also do land leases. They'll take a land lease and just build whatever they're going to build, and I guess that gives them a tax write-off at the end of the year, because they're leasing the property. Do you think that is a better route to go for a retail company?
On the scale that Walmart engages in that transaction, yes. For corporately funded national brands or those of that class of merchants, possibly. I know Sears has a similar strategy. However, for self-funded regional and local merchants, that may not be the case. Ultimately, if it improves sales and the net effect is an increase in income, that's the right strategy for the merchant. But in a short amount of time, I think that's how I would distill that.
Okay. Well, let me get your opinion on this, Michael. Now, with this impacting retail, now when we're talking about the Walmarts, we're talking about Sears, we're talking about big box retail. Now, let's go to the local guy that has an 800 square foot storefront. Okay, this is actually going to slap him right in the face. Would you agree with that?
Yes, and I know you may have intended to bring it up, but with the affordable health care costs for that type of employer, absolutely, so much more so. It's compounded.
Yeah, and that's the thing that kind of like throws me off, and I want to get your opinion on what the impact on small business. And I mean, if you had to put together a scenario to help small business in an environment like this, what would you do? What would you tell someone? What kind of guidance would you give them?
For real estate investors, merchants, or
for merchants that are looking to lease a storefront, let's say, because look, America is built on small business, so I'm kind of looking at that because I think that small businesses like that are going to get slapped right in the face. And I'm hearing things all over the place as far as what could happen, what can happen. All I know is that if all these things go into effect, that small merchant is going to be facing some adversity. So just from your expertise and your background, I'm just curious on what do you see, maybe what do you see them doing to in a situation like this? Maybe it's an unfair question, but I'm just trying to pick your brain a little bit.
No, I appreciate it, and sorry for the delay. Excuse me, but it depends on the market. I think robust economic growth and demand for space will offset higher taxes. That may not be the case for a lot of small business employers with a large fixed payroll expense. You're going to look at folks reconsidering how they staff up their small business. Obviously, full-time employees are going to cost more. In terms of leasing, you're going to see increase in medical costs, obviously, of the employees. However, you're going to see a reaction from the commercial real estate market developing greater healthcare space or increased healthcare space with retail usage, meaning medical clinics at storefronts. So the demand, the limited availability will ultimately drive up some of the leasing costs.
Mm-hmm.
But in the most resilient markets, I think you'll see retail stabilizing enough to offset some of the added costs for small business merchants.
Okay, all right, that's fair enough. Now let me ask you. With we've been speaking about retail. Now, what's your take on office buildings and office leasing? Do you think we're going to see an increase in that, or do you think we're going to see a pullback in that area as well?
That's going to be partly influenced by unemployment benefits, job creation. However, those tax increases affect the employer's ability to create jobs. That's going to determine just how much office space is absorbed in the market, how much office space is developed. The old model used to be 200 square feet per employee, but now that the nature of work is changing and we're thinking of work as something you do and not someplace you go, and you're seeing the change both in private and government sectors, folks are using mobile technology, office sharing, very innovative solutions that we had not previously considered in office as a way of cutting costs, increasing efficiency. A lot of folks look to healthcare on their budget as one of the top 3 items, and it's an opportunity to cut costs. So if you can figure out a way to squeeze productivity out of smaller space, you're seen as an effective manager or an effective overseer of whatever your business is.
So that would mean that a business that has office space, they would have to get innovative in order to offset these ancillary costs that are going to be coming in next year. And
I believe so.
Yeah, and I think that's going to be interesting because if someone, let's say a company, and let's say they needed, let's just say 5,000 square feet to run their office, if they get innovative, they can actually cut that down to probably 2,000 square feet or 2,500 square feet and still make it functional for their needs if they need to, and that's cutting costs.
I agree. That used to be a dramatic shift, but I'm seeing more and more functions or roles being outsourced to independent contractors, more freelance work, and like you said, just a simple reduction in the occupied space.
And look, every market is different. I mean, you're in California, so that market is different than the New York market. But at the end of the day, this is what's going to be coming down the pike is going to impact every market, big or small. It's going to impact everything across the board. So the same, adversity that someone may be facing in, let's say, New York, they'll be facing the same thing in Florida or Tennessee or in California, because you're talking about federal tax raises, and it's going to really have a major impact, in my opinion, on everything that's going to happen in commercial real estate. Like the Trump moves, and again playing the monopoly game, I don't think is going to be proficient anymore. Depending on what happens, but I don't think it's going to be proficient as we roll into next year.
I think you're right, Lou. Those are all uniform net effects across all metro areas, and like you said, most markets where commercial real estate and this sort of activity is significant.
Yeah. Okay. Now I want to shift topics a little bit because you're a commercial real estate professional, and you've been doing it for some time, and you've dealt with some I think the Fortune 100 companies you've dealt with? Yes. Yeah, during your career. Now, I know that you have a lot of companies out there, and they actually bring on commercial real estate professionals in order to train them, to groom them, the whole 9 yards. But you have again, this is what I see anyway, that you have a lot of people that aren't experienced. They don't have the knowledge. They don't have the education in that area, but they're out there working in that field. Do you think that forget about what's happening with fiscal cliff. This has to do with the business commercial real estate. Do you think that has a negative impact on commercial real estate within itself? Not having that, people not having that education in that field to go out there and work with clients and either buying or selling or leasing or whatever they're doing in that realm.
Luckily, in the industry, the technology platforms are so commoditized that you're able to run the same analysis as folks who have spent years in the industry. You may not have the intuitive, strategic way of looking at, the academic lease provisions or the points on the contract, the economic deal points in a contract. But luckily, technology has flattened that terrain. I think if you're financially focused, you could still develop a real estate strategy for your client, treating commercial real estate as an investment vehicle, just as you would any financial instrument. But no, if folks are interested in getting into commercial real estate now, it's going to be tougher to sort out a deal. Obviously, the returns are affected by the new tax laws, the increased tax on capital gains and dividends. But no, as far as sales, leasing, it's still a production sort of function.
Okay, so it's just it's a numbers game. That's what it comes down to.
Yes, sir.
Yeah. But as everything changes here, the reality is you have to be educated in what's happening, because if not, you're not doing your clients any service.
Absolutely. If you're not adding to the analysis that your client is able to conduct with the applications available out on the market, and if you're not building a stronger NOI, working out a more favorable deal, what are they paying? What are they paying you for, essentially?
Yeah, exactly.
And that's
go ahead.
Oh, sorry. And that's where the experience comes in. You'll see sophisticated brokers and investors work out, more mutually agreeable terms on a contract.
That makes a lot of sense, because there are a lot of moving components and now these moving components are going to be more essential, going into the new realm that we're going to be going into. So, I mean, whether you're leasing, buying, selling, it's not going to matter if you're not educated in what you're doing. And I'm not even saying about going and getting a commercial real estate certificate and hanging on your wall and that type of thing, but you have to have some sort of education, at least self-educate yourself in what's happening, because you're going to be helping your clients. Now, let me ask you this, Michael. Since I'm picking your brain this show, and I appreciate your patience. When I mentioned earlier about the Mortgage Forgiveness Debt Relief Act expiring. Now I know that is going to, and I said earlier, it's going to directly impact the people that own homes that are maybe they're behind the eight ball. They're upside down all around, they're sideways, and a short sale allows them to get out of this situation and allows an investor or a first-time homeowner to come in and grab the home and take it off the market. Now, if that Mortgage Forgiveness Debt Relief Act expires, which it is, and they don't do something, they just let it go. Now, do you think that the people that were going to be short sellers, and that were behind the eight ball with their mortgage, and they were going to be able to get out of it, do you think that act expiring and them that they will get taxed on whatever short sale they did, do you think that's going to kind of push people not to do that come next year?
Possibly. For some folks, especially the middle class, where that's one of the largest deductions on their annual tax returns, they may not have an alternative. And that's why I think you're seeing a record number of defaults.
No, it's sad because, they could do something, but at the same time, I think that when everything came to a head, and you may have a different opinion, but I think when everything came to a head, when we hit the financial crisis, they should have just let whatever was going to foreclose and let it go, and let us build up a little quicker, as opposed to this long drawn out thing going over years, where now we're paying a deeper price.
You're right. That's actually part of the mainstream rhetoric and that applies, I think, both on the commercial and the residential sectors. Just let these debtors default. Let the correction happen instead of protracting it out and extending some of the costs. But the counterpoint to that is how much more damage would we incur were we to let that happen. So I don't know if I'm not going to pretend to know the absolute understanding of each side of that argument, but I think there are valid points to both. Yeah,
I mean, we can analyze it, from here to doomsday. It's not going to change it because the reality, it's already done, and it's like the what ifs. What if this? What if that? At this point in the game, I think that anyone that is behind the eight ball with their mortgage, when this Mortgage Debt Relief Act expires, I think that they're gonna any opportunity or any choice they had to get out of their situation is going to be taken away from them, and they may just be facing foreclosure, even though they have all these programs in place, to keep you in your home forever. The reality is, maybe I think maybe we're going to have an increase in defaults, based on what's happening.
I think you're right.
Yeah, and it's like as I said, it's everything. It's a domino effect all around. And I bring that up. I know your forte is commercial real estate, but the residential, this part of it actually impacts everything because if that should fall, then everything starts to follow suit. And I hope that they take that into consideration, because if people don't have money for their home, they don't have money to invest in the market. they don't have money to drive to go buy things, go to retail stores, and keep those businesses in business by patronizing their stores and going in there and buying things, and they're able, the merchants are able to pay their rent, and then everything's connected. We have one little web, and pulling one string can kind of rip everything apart.
You're right, and I'm stating the obvious, but even though commercial real estate is a distinct area from household income, commercial real estate is a laggard in the economy, meaning how much folks spend at retailers is directly affected by their household income, and people need to have jobs or office space to be developed and leased. People need to have discretionary income for retailers to sign leases and show an increase in gross sales, and gross sales is what makes or breaks a shopping center. So that I can speak to, but you're right, it's very much interrelated, and the net effect is whatever happens to the consumer, whatever happens to employers, job growth, household incomes, has a direct effect on the commercial real estate market.
Oh, well, let me ask you this, Michael. Just one last question. Now, I know that your focus is retail, all right, but do you see in the overall realm of commercial real estate, I know over the years a lot of foreign investment was coming into the United States, and you had a lot of foreign investors coming in buying commercial real estate across the board, in all markets. Now, do you know if that has slowed down, or is that increasing as we're moving towards this fiscal cliff?
I'm seeing it increasing. Southern California may be unique in that way because there's a lot of diversity and there's a lot of access to the Pacific Rim investments, foreign capital wanting to acquire American or U.S. Assets. But it's funny that you bring that up. A lot of the folks I work with are multilingual or bicultural at least, and you're seeing a lot of private investors with foreign capital, and I'm not hearing a lot of discussion on that market. So it's interesting that you brought that up, but that activity has been stable the past 18 months or several quarters, and I'm seeing increase in interest at least. How many deals are going through? I don't have the data in front of me, but at least in Southern California, I can say that that particular transaction is increasing.
Okay, that's fair enough, because I was curious about that. Only because you look at foreign investors, they've been sitting on the sidelines waiting to see what's going to happen. But at the end of the day, if they may be able to snag deals, because if someone's looking to sell a commercial property, better to do it now than in January.
Absolutely.
Yeah, so you will probably see more activity as we round off this quarter. It's going to be interesting. Without a doubt, it's going to be interesting. All right, Michael, I thank you for coming on the show. I wanted you on here for your insight, and you did give that, and I appreciate that. Why don't you let our listeners know how they can connect with you, how they can find out more about you, because they may have questions, they may want to do business with you, they may want to just find out more about you.
Absolutely, Lou. Thank you for inviting me on the show, and thank you for letting me participate in your discussion. Lou and I connected through social media. You can interact directly with me at Michael_MBA. I'm a retail broker here in San Diego with Rosano Partners. You can go to our website and contact me through that medium. But again, thank you, Lou, for the opportunity, and I really appreciate your time.
Michael, you're more than welcome, and I do appreciate you coming on. Again, it was short notice, but it was definitely well worth it. You gave us a lot of insight into retail commercial real estate, but commercial real estate, actually real estate within itself, because it's going to be an interesting time, and I want to have you. I want to actually bring you back on after after what happens in January, because you may have some additional input at that point, because a lot of things are going to change, and our listeners are definitely going to need that help, that guidance. So hopefully you can help with that.
I'd be happy to, Lou, especially after January 3rd. That would be an interesting discussion.
Yeah, exactly. I think we need to do that. Let's arrange that, Michael. Okay, but I thank you again for coming on the show, and I want our listeners just hang tight. We're going to be back on Money Never Sleeps after this short intermission.
The Palestinian civilian death toll is mounting Monday after Israeli aircraft struck the Gaza Strip. At least 4 people were killed, 42 injured, up to 15 more are missing. The airstrikes are an attempt to crush militant rocket fire from Gaza that's been hitting Israeli civilians. President Obama is encouraging Myanmar to continue its transition to democracy.
Let us remember that in a global economy, a country's greatest resource is its people. So by investing in you, this nation can open the door for far more prosperity, because unlocking a nation's potential depends on empowering all its people, especially its young people. This nation that's been so isolated can show the world the power of a new beginning and demonstrate once again that the journey to democracy goes hand in hand with development. I say this knowing that there's still countless people in this country who do not enjoy the opportunities that many of you seated here do. There are tens of millions who have no electricity. There are prisoners of conscience who still await release. There are refugees and displaced peoples in camps where hope is still something that lies on the distant horizon. Today I say to you, and I say to everybody that can hear my voice, that the United States of America is with you, including those who have been forgotten, those who are dispossessed, those who are ostracized, those who are poor. We carry your story in our heads and your hopes in our hearts.
Hostess Brands will be in a New York bankruptcy courtroom to start the process of selling itself. Hostess is the maker of Wonder Bread, Ding Dongs, and Ho-Hos, and its Twinkies alone have brought in $68 million in revenue so far this year.
Unfortunately, yes. It started as a reorganization and today moved to a liquidation because we simply could not get enough workers to come off the picket lines to return to work and restore normal operations.
So the value of the company with no debt, with all of its debt wiped clean, which is basically what we're talking about when we're talking about, coming out of bankruptcy court, probably could be in the $1 billion range. This time next year, you'll be able to go in and most likely be able to buy your Twinkies and your, other Hostess products.
Butterball Turkey Talk Line, how can I help you?
And when that phone rings and we say good morning, Butterball Turkey Talk Line, how can I help you? We don't know what we're going to get, but it's always a joy to answer those questions.
It's because many people really feel like they've planned well and they've got everything down, and all of a sudden their stove breaks. All kinds of things can happen. You just name it. We could not have a list of every call that we get because it's just such a wide variety, which makes it fun for us too.
Funny call. Probably the gentleman wanted to thaw a turkey, and he wasn't sure exactly where to set the dial for thawing the turkey. And I said, the dial on what? I thought maybe he was going to try it in the oven. He had it wrapped around. He had wrapped around the turkey an electric blanket, and he wanted to know where to set the dial. I said, oh my goodness, have you turned it on yet? No, he said he hasn't. So I said, take it out of the blanket, put it in a large sink or tub of cold water, and that 12-pound turkey will thaw in cold water in 6 hours. So we saved the day. He can cook the turkey, but he was in a hurry.
Even now today we have Facebook and Twitter and Pinterest, and then you can go live chat through the Butterball.com. Even this year we have a Butterball app, so we are so contemporary. First mother-in-law, the mother-in-law coming over for the first time, and she wants to do, really impress her, and she's scared to death of how to do it. And we've had them where they've been calling from the back room, because trying to make sure that they're doing the right thing. So
we're largely hand holders for people who are maybe cooking their first turkey, and that could be at age 19 and they're away at college with friends who aren't going home for the holiday, or it could be somebody 79 years old who's cooking their first turkey.
Home sales activity was at an annual pace of 4.8 million, with a median home price of $187,000. That's up 9.5% from the same time last year. According to Freddie Mac, the national average rate on a 30-year fixed-rate mortgage fell to 3.49%, a new historic low.
All right, welcome back to Money Never Sleeps. And we had a great guest in the last segment with Michael Lagazzo. He gave us a lot of insight into commercial real estate, retail commercial real estate, and it was really interesting. We're going to have him back on after January 3rd so we can get some more insight to what's going on in the world of commercial real estate, especially with that 3.8% tax that's going to be happening and the capital gains tax and everything else that's going on with this fiscal cliff. Now, let's get to some nitty-gritty insight on the fiscal cliff and the hedge fund industry, for that matter. So I want you to join me in welcoming back John Dines of REO Capital. John, welcome to the show.
Thank you very much, Lou. I appreciate you having me on again. And a lot of things have developed since we spoke last, and we can dive right in and talk about that whole mess.
Well, I think that we need to dive right in because getting our toes wet at this point is not gonna cut it.
That's true, Lou. It was interesting because over the weekend I had a meeting with another private equity firm based out of New York, and some of the interesting thoughts that came out of that meeting were a lot of people within the hedge fund industry and private equity industry, especially private equity, who are right now or have looked at any part of recapitalizing their companies or selling a portion of their companies, are looking a lot more serious at that venture now before the tax increase occurs in January, as well as the capital gains that would occur as well. So taxes are weighing very heavily on many of the private equity firms and hedge funds out there in the market today.
Yeah, I mean, I can see a lot of things happening like that, a lot of shifting. You know, when I mentioned in the segment earlier, when we were talking about commercial real estate, John, and how people are shifting. You know, anyone that has a commercial property is better to sell it now than next year if they're looking to sell it, because they will get hit with that tax increase. We just don't know what it's going to be yet, but it's going to be there.
Right, and also the interesting thing that came up in the conversation was for the people that do have their businesses and they do decide to sell a portion of that equity to recapitalize, they're going to look at their workforce as well, and they're going to start looking at the cost of health care. They're going to look at the cost of increased payroll taxes. So these additional costs of running that business is also going to weigh heavily on the industry, and there's going to be some changes in the employment status of many different companies as well.
That's interesting. You know, it's funny. This is what I found interesting. Warren Buffett. He was on television. He was suggesting. He's been suggesting this for a little bit, but he's suggesting more now than ever for the millionaire tax. Suggesting that if you make anywhere from $1 to $10 million, you should be taxed at 30%, and above $10 million, 35%. You know, I know that a lot of high-end CEOs and officers, directors, so on and so forth. If they have, let's say, like Warren Buffett, he owns a company. He gets his income taxed as capital gains, but that's also going to change for him as well.
Right. And the other thing that came up in the conversation as well is earnings. Many corporations are looking at not being able to meet their earnings expectations, and subsequently that lack of ability to meet those projected earnings estimates are going to have an effect not just on the corporations themselves, but on the markets as well.
Yeah, I mean, that I see for sure. The thing that kills me, John, is that, we have these entitlements, and they need to be adjusted. I keep hearing raising the taxes. I don't hear anything about the entitlements being adjusted in any way. I mean, do you see anything happening with that?
The interesting thing is, as we spoke last week, the proposed amount of taxes versus spending cuts was, I believe, like a 3-to-1 ratio. 3-to-1, being higher taxes, 1 being spending cuts, and of course, no one wants to be the bad cop and propose spending cuts. But you're absolutely right. Entitlement programs. We may need to look at a voucher system with respect to Social Security or with respect to Medicare.
Yeah, well, they're going to have to do something, because you can't keep increasing taxes. Because look, they were talking, like Warren Buffett said, with raising taxes on the wealthiest 1% to 2% of Americans. But the reality is, you can raise that tax to 50, 60, 70%. It's not going to make a dent on what's happening out there. If you keep spending, what are you doing? The spending has to stop.
Right. We have to make a balanced budget. You're right. You can't go on and spend as much as you like, and then just raise taxes to try to cover that spending.
Mm-hmm. Well, let me ask you this, John, because your insight into the private equity sector is pretty deep. Now, do you see more private equity firms? Do you think they're going to start looking at riskier investments with higher returns because of what's happening?
No, I think what will happen is, as a lot of these companies are not meeting their earnings projections, and they're going to be looking at cutting their workforce. They're going to. A lot of these guys are going to look for the golden parachutes, and they're going to be looking at getting, taking some offers. And typically, excuse me, what I've found is a lot of these guys have been in the past holding out for the most advantageous offers from whether it's from venture capital or private equity, or whether it's from other types of sources, hedge funds, and some of them have gone to the extent of taking much higher payouts, in even knowing that their companies are going to be broke up and sold at a garage sale in bits and pieces, kind of like what Gordon Gekko was doing in Wall Street.
Mm-hmm.
Just breaking up the companies, selling them off in pieces. But I think you're going to see more and more companies look at those numbers and look at them obviously in a much different light, because they're not going to be hitting the type of numbers, that earnings projections, etc., that they were hitting in past. So they're going to unfortunately have to take a lower figure if they want to get out.
And that, actually trickles down to the economy again, because if you're taking a company and if someone's going to be a robber baron and they're going to take it and, break it apart a la Gordon Gekko and sell off the pieces to make a profit, take the pension money, everything else, and you'll make money for the people that invested in taking over the company. However, people are losing their jobs.
Right.
and that impacts the economy.
And this meeting that I had with a private equity firm that said the very thing. They even said to the CEO, "Aren't you concerned about your employees?" He says, "No, I built up the company, and I'm looking for a certain rate of return, and I'm the firm that's going to give me the best rate of return on my company, and I don't consider to the company."
And I mean,
you're going to see more and more of that taking place.
It's like a dog eats dog situation. Is you have to. It's like you have to get your, as you mentioned, your golden parachute, because if you can't save the world type of situation. It's going to be interesting, John.
I think that, and Bees is another company already that's looking at cutting their work from the news and talking about health care and the cost of health care and what it's going to mean as far as cutting hours, employees, and the higher taxes. All of this is going to come at a time where the economy is fragile still. And as I said, 2 years ago, President Obama mentioned that he didn't want to look at the Bush tax cuts because the economy was too fragile, repeal the tax cuts. The GDP back then was 3%. GDP today is 1.6%. So now we're looking at repeal tax cuts in an economy that is half the growth of what 2 years ago.
Yeah, and look, last time we spoke, John, us going on the fiscal cliff was 42 days out. Now we're 35 days out, and nothing has changed. You have, Congress was out because of Turkey Day, so, and we have Christmas right around the corner. I don't know what kind of magic that they're going to make between now and then, but it better be a serious Houdini act for sure.
Yeah, what was interesting to me over this time as well was that the amount that people spent online and in the stores was greater this year. It took me by surprise. With the economy the way it is, I'm just really, really surprised that more weren't a little more with their spending during the holiday period.
Well, I think that people they're looking at deals. I mean, you watch television, you see someone selling let's say a 32-inch TV that's normally $300 and something. They're selling it for $100, and there's a run on it, and the stores are, they're looking to increase their increase their revenue that way. Not that they're making a hell of a profit on it, but I don't think people really understand the magnitude of what we're facing, because it's going to hit everyone dead in the face. I don't care what asset class you're. I don't care where you're at. I don't care if you're poverty-stricken, middle class, you're rich. This is going to affect all classes.
It is, and people, you're right. Absolutely, they do not. And this is another discussion that we had over dinner during our conversations with private equity as well as the economy, that people do not have any idea how much these higher taxes and how much this health care is going to cost everyone, and how much of an impact it's going to have on everyone's pocketbook.
Yeah, and it will. I mean, healthcare alone, you take a small business and they're forced to do X, Y, Z. Now, all of a sudden, their revenue stream is being cut. Now, not only are they forced to pay for this, now their taxes go up. Okay, and when they go over that $250,000 mark, all of a sudden their tax rate is going up. Everything is going up. How do they stay in business?
Right. Well, they're going to cut back on hiring. They're going to cut back on spending, It's going to impact GDP growth. It's going to impact unemployment numbers. It's going to impact the cost of fuel. All of that's going to be passed on to the consumer. Everything, and for President Obama to say that 97% of people making under $250,000 are not going to see their taxes increased is a big, big illusion. That's the best word I can describe.
You say delusion, I say crock, because the reality is everyone is going to get hit. Everyone's going to get hit. They have this 2.8%, tax that's going to come into play. You have the mortgage debt relief act. That's going to expire. You're going to have people that are upside down on their mortgage. All of a sudden, they can't do a short sale, because if they do a short sale, they're going to get taxed on it. So now, all of a sudden, you're hitting all types of blockades. And if you lose your job, forget about it. And still, you're still getting hit with the taxes. And the spending doesn't stop. But meanwhile, they want to subside on the spending for military, which is another story within itself.
Right. And it just goes on. And when all of a sudden everything starts to compound, my best guesstimate is that the American public is going to be fed up by this time next year, and they see that there's less in their paycheck, there's higher taxes on top of that to pay in the following year's April 15th, and then on top of that, they're going to see that their health care is not going to be covered by all the physicians. They're not going to be able to go into every different doctor and every different hospital they want just because they think Obamacare is going to be there to bail them out. It is going to be a rude awakening for many, many Americans who feel that they depend on the government. And for the seniors who have paid into their Social Security, but have really outlived the benefits that they've paid into, and they're going to see higher taxes on their Social Security, just as President Clinton raised the taxes on Social Security income as when he was in his administration.
And the thing that's funny about that is that everyone, once the new year rolls around, all these new tax laws and all this stuff goes into effect. Your Social Security, your payout to Social Security is going to go up too.
Right.
But they're treating all that. They're treating that as a separate problem to the fiscal cliff, but it's all part of the same thing.
It is, and yet to have the Obama administration put a commercial out on the television depicting Congressman Paul Ryan of taking seniors and dumping them over a cliff as the solution to Social Security is outrageous.
Yeah, I don't see, and it's funny because people with money, they're sitting there and they're cheering rah rah rah, but I don't think anyone, I don't think they're looking at what can happen later. They're looking at what can happen today. They're not looking at what's going to happen in 6 months and 12 months because they're going to get hit as well. So
I'm just reading in the news that lawmakers are looking at roughly $600 billion in tax increases, not to mention spending cuts that will start to hit households and companies in early January.
Well, and then you're going to have an increase in when you go shopping, you're buying food. That's going to cost more. And
food will cost more, and inevitably so will gas prices.
Yeah, and it's a never-ending cycle of stuff, And the thing is, as I said earlier, before, 35 days out, we're no closer than we were 2 weeks ago.
No.
No
progress has been made on those spending cuts. The only progress that I've heard in the news is that the GOP has now realized that they're going to have to give in to tax increases, where before they were adamant about no tax increases and tax reform. Now they're willing to agree to tax reform and tax increases, because I think that they see that there's not going to be any other way out of that, and there's going to be tax loopholes closing, and all of that is going to go into place. But I've heard nothing on the side of spending cuts, other than the fact that they're looking for spending cuts to total $1.5 trillion over 10 years.
And that's the thing that I find funny, John. That Boehner, he's the GOP. They're bending to say, okay, we'll have tax reform. We'll bend on increasing the taxes. I'm sure no one in this country would have a problem with having the taxes increased if spending was reduced. Okay, in the right way. Because if your taxes are being increased, but meanwhile you're supporting someone that doesn't want to work, or all these health programs, and what's the benefit? What are you getting out of it? What's this country getting out of it beyond coddling people? And I mean, I look at it as a parent. If you're a parent and you have a child, if you coddle that child long enough, that child's going to be so dependent on you that child will not be able to stand on its own. And in this country, don't we promote growth, standing on your own 2 feet, and facing adversity and getting through it, being strong? Right.
And also, in addition to the spending cuts, you've heard nothing about the Democrats coming up with any type of agreement on any type of entitlement reform. That subject seems to be something that they don't want to address. There again, no one wants to be the party that they point the fingers at and say, well, yeah, we have to reduce the amount of benefits, or we have to increase the age in which you start to collect Social Security. All of these things, these issues with respect to these entitlement programs, welfare, food stamps, all of that has to be addressed in addition to the spending cuts. And you can't just point the finger at the military and say, well, they're building these type of $35 million jets, and therefore we'll just stop production of these jets. That's not going to be enough.
No, that's definitely that's the thing. It's like a head fake. It's like bringing attention to something like that, but you're kind of missing the whole point of you have a ton of federal employees where you don't need as many as you have, but you hire them to show an increase in employment. So I don't know. It's like a little game that has to be addressed, because I don't know. I think the fate of this nation, is there. It's weighing. It's kind of like it's just on a scale there, and they need to really put their heads down and just suck in their pride. All these politicians, and get on the same page. Forget about your whatever political party you're with. It doesn't matter. It's about fixing the problem here, and then you can go back to arguing next year, but not now.
Right. And the other thing that we were discussing over dinner over the weekend was, as we mentioned last week, as all of these factors start to come into play, and you start to see earnings numbers collapse, and the stock market will inevitably tumble. We'll see the equity markets and the bond markets are already paying out very minimally, but the private equity sector, in talks that we were over dinner, we were looking at 30% returns on these private equity deals. Now, if the equity markets are going to tumble and the bond markets are already in the toilet, and we're not seeing people able to find anything reasonably well to invest in, inevitably they're going to turn towards that private equity market, whereby they are going to see those 20 and 30% numbers to invest in these deals.
Right. Well, I mean, look, it's crazy to me, John, where you have money flowing out of high yield bonds, high risk bonds, but then you have money flowing into munis, which is funny, and the market's going up. It's like everyone's confused. Everyone's confused across the board as to what's going to happen.
It is. There's going to be a lot of confusion, and I, in addition, as you know, a lot of these seniors also are going to be. They're dependent on their dividends. As the equity markets start to tumble and earnings numbers are not met, inevitably, corporations could very well cut their dividend rates as well, therefore affecting the seniors who are dependent upon those dividends to make their additional income that they've been lacking.
Well, and that's why you see a lot of companies now, like Walmart and Wynn Resorts. They're actually posting a special dividend before the end of the year to try to, they're trying to do a service to their shareholders. But at the end of the day, these people that, as you said, years ago, it was IBM, it was big companies where you had people that held it just for the dividends.
Right.
Okay, and now with what's happening, I think that the value to them is going to be a lot less than it was in previous years, because if you're getting hit with that crazy capital gains tax, then what's the purpose?
Right. Exactly. And if Congress continues to do nothing, it's inevitable that we will go over the financial cliff. And as that happens, as we've been discussing on the program, I really hate to think of the impact that it's going to have on this economy and the type of devastation that it's going. Instead of us progressing forward, we will take 3 steps back for the one step that we've moved forward.
And do you see us going into some type of recession?
Double dip recession, absolutely. Okay. We're going to see, as the workforce is cut, we'll see unemployment numbers go up. We'll see companies going out of business. We'll see those tax increases. But if this financial cliff, we go over that, and we continue to see that, inevitably there's going to be companies that won't be able to pay those additional taxes as well. They'll go out of business as well, not just because of the financial markets, but because of the higher taxes and because of the health care impact it's going to be on their business and on their employees. And so I see a domino effect. Here, President Obama was worried about trickle-down economics not working. Wait till he sees what the domino effect is going to do.
Yeah, and then at the end of the day, the people that pay the price are the consumers.
Exactly.
Yeah, because they want to pay more for everything.
And this is why I think I was quite surprised that people weren't more cautious this holiday season with their spending. With January, with 35 days right around the corner, I don't think the American public has any idea of the financial impact that's going to take place after January.
Well, I mean, they're going to find out, because we're all going to find out when everything happens, And look, we had the Black Friday. They give names for every type of sales thing, trying to, market it the right way to get people to come by. It's a marketing technique. Black Friday, okay. Now you have Cyber Monday, okay. Now I believe beginning of December there's another thing. Then you have a free shipping day or something. They're doing all this to market to get you to buy products, which is it's a good marketing strategy. You can't blame them for doing that. But the more people spend, they think that the gravy train's going to keep on coming. But when these companies start hurting, it's going to come down to the employees because they're going to start hurting as well.
Well, there was a woman on the news in New York who owns a Hallmark card shop, and she could not afford to pay Hallmark what she owed them, and they deferred her. Normally, her shipment was, I guess, a net 30 basis, and they extended her credit in order for her to restock her boutique so that she would have goods to sell.
And then that puts her behind the 8 ball a little further too.
Right. So if she's one little piece of the puzzle that's already experiencing this type of impact on the holiday season, and she said she relies 40% of her business is reliant on the holiday season.
And that's we're in that season now.
Right. So if she's one person who's dependent upon having credit or being allowed to the extended credit, when credit is so tight right now, I really hate to see what's going to happen as that credit tightens further.
That's true because Hallmark, they extended that that credit on the items. And I'm luckily for her that transpired. But that's not going to be the luck of a lot of people that need that assistance. They need that little bridge to get them over to the other side, because you'll have a lot of business failing. A lot of small businesses will fail if they have no access to credit.
Correct. And she was in tears, pleading with Hallmark to extend her this credit, and not every company is going to say yes and float you, and we can go ahead and finance you.
Because they don't have the capability to do that. And even if they did, they have their own company to run.
Exactly. They've got their own earnings numbers, earnings projections to meet, and not every company is going to be able to afford to extend that kindness to people who are being impacted by this financial cliff.
But the killer, John, here is that say you have a company like that can extend credit to a retail store. Now, what happens when that company can't do that? Now, they don't have any outlet to sell their items. So they're not making money, and no one's making money. The consumer, if they're not buying, this goes up the chain a long way.
Sure. And that's why I said in the previous programs that as credit starts to tighten, as the equity markets start to tumble, as consumers stop spending, people are going to have to look for other alternatives. And that's where I firmly believe that, as I've seen already just over recent conversations with other private equity firms, that they're looking at and they're talking already. One firm for next year has got over 200 different companies in their pipeline that are looking for either recapitalization or looking for a buyout for coming up in 2013. I think you're going to see more and more of that occur, which is going to, for the silver lining in the black cloud is going to be those companies have had these small business owners have worked 20, 30 years to build up these companies and have been made them profitable, and now they're going to have to liquidate these companies, and there's going to be a large garage sale. And in that large garage sale, there's going to be a lot of profitability for firms that are able to pick up these deals at a bargain price and be able to pass those on to people who do have the financial ability to invest and real benefits of 20, 30, 40% returns.
And this is a classic. Only the strong are going to survive in this deal, situation. And for the purpose of our listeners, I want them to understand that the companies you're talking about, the 200 plus companies that were approaching or he has in the pipeline, that one private equity group, these are going concerns. They're not startup situations. So you have a lot of companies that are actually, going to be hitting, I guess, a brick wall with, the top people are going to have to make a decision. Do we look out for ourselves, or do we try to save all the employees and the company and so on and so forth? So it becomes a decision, with what we have going on in the very extremely near future. And that's very interesting.
And these are, by the way, these are middle market companies that are these are not late stage companies that are already in their maturity levels. These are middle of the road companies that are on their way to building up their financial nest egg, and these are companies that are in their prime of doing business and that are going to be stopped short of that goal. Because you're right, they've got to make a decision. Do I go ahead and continue and try to stick it out past this financial cliff and hope for the best, or do I take my money and run now?
Yeah, it's going to be an interesting thing. It's going to be an interesting situation as things develop, without a doubt. John, big question for you. Now, for the purpose of our listeners, when you're dealing with private equity, obviously you have to be an accredited investor to be involved in a hedge fund or a private equity situation. But just to explain to our listeners how that works. Let's say if they were an accredited investor, and they were to invest in a private equity firm, what's the hold period on that? Would they have to hold 12 months, 24 months? How does that work?
Well, that's a great question, Lou, because for your listeners, for those who are even not accredited investors, if they've got an account at a registered investment advisory firm, which is a type of firm that typically charges a fee for managing their assets, typically they're over $100,000 or more. Sometimes their minimums are $1 million or more. But for people who invest with these registered investment advisors, they typically allocate anywhere from 5 to 20% allocation in alternative investments, being hedge funds, private equity funds, and so your listeners who may typically have an account at a Merrill Lynch or Edward Jones can now look at a registered investment advisory firm in their local area and be able to, instead of being charged a commission, they're charged a flat fee based on the amount of assets that they have under management. And this way, the registered investment advisory firm, they get a pay increase if they do a good job for their investors. And if they don't do a good job and the markets tumble and they're heavily weighted in the wrong sector, they get a pay cut. So, but for those who are accredited investors and those who do have a net worth, excluding real estate, of $1 million or more, and incomes of $200,000 or above, then they can participate in these private equity funds. And this particular company that I was in discussions with typically worked on one type of deal at a time. However, what my firm is trying to do is to get them to look at a different avenue, to take multiple different companies and wrap them inside of a private equity fund and allow, whether it be the registered investment advisory firm who has discretionary control over individual client assets, or as the accredited investor who's going to put minimum usually are $1 million. Most of the time is $5 million investments. But the lockup period is typically 5 years. So these type of investments are not short-term investments, and usually they either end up with just a restructuring of the company, or if it's a late-stage private equity investment, it's going to be an exit strategy of an IPO or some other type of exit strategy. But there's also a silver lining in that cloud as well. Even though that lockup period may be 5 years, this particular company that I'm in discussions with is looking at providing a part of it in debt, part of it in equity. So they're going to pay out a 10% coupon on the debt side, and they're going to pay out a 30% investment or IRR on the equity side. So if you're involved in a 5-year lockup and you're getting some liquidity through the debt side and getting a 10% coupon on your investment, there's really no need to look at or be worried about tying up your assets or a portion of your assets for 5 years. Because I don't know too many people that would be disappointed about getting a 10% coupon and getting a 30% return on their investment.
No, not at all. Especially now, as I said earlier, a lot of people, they're confused, so they're kind of slipping out of high yield, high risk, junk bonds, and they're slipping into munis, which is confusing in this market, because you're leaving one thing to go to another thing that may pull back come January. So it's just interesting. Now, when someone invests in a private equity, okay, and the lockup is 5 years. Now, what are the tax consequences for them? Let's say if someone was to make an investment in a private equity firm today, okay, would that money that they invested in that private equity firm, would they have a tax consequence going into next year or the year after that?
They'll have a portion of that investment exposed to capital gains taxes, because as each year goes by and they are getting that 20-30% return on their investment every year, then yes, there will be capital gains issues involved on an annual basis that they will be subject to. Obviously, though, if your capital gains is at, if your investment rate of return is at 30% and your capital gains is still at 20%, there is you're in the black still with your investment. Not to mention you're getting that 10% coupon. Right.
But that's if the capital gains rate is going to be at 20%. We don't know where it's going to be.
That's right. That's right. We don't. But obviously, this is another justifiable reason for people turning to private equity as well, because if capital gains does go up to 25%, then people are really going to be forced to look at other alternatives to make a positive rate of return on their investments because capital gains is going to eat them up.
And let me ask you this: with private equity within itself, without a coupon or without the annual payout. Now, if someone, I mean, I know there are private equity firms out there that have you locked up for this amount of time, and if they are giving you X amount of percentage per year that you're making on your money, if you reinvest that, are you getting taxed on that as well, or is that deferred?
Well, no. If you're going to reinvest that back into the fund, that would defer most taxes. I'm there again. I'm not a CPA, and I don't pretend to be an expert at taxes, but I'm quite certain that you're not going to escape all the tax aspects of investing, whether it be in private equity or no private equity. I mean, even if you reinvest, there's going to be some tax exposure. I would be assumed.
Right. I'm thinking it's probably better if you are looking to put your money somewhere and have a profit, put into a private equity, let it sit there for the next few years until the next administration comes in, and maybe you'll be better off. Right. That 5-year lockup might be a very good thing with respect to deferring your investments because by the time you end up coming out of that deal at a 30% rate of return, you're going to be in the black, not to mention it'll be in the next administration. Exactly, and hopefully things will change from there. Well, that's really interesting, John. Now, that private equity deal that you were just talking about before, is that something that you're working with directly? Right. This is a company that works in New York that is exposed to a lot of different companies that are really looking to either take that golden parachute or just outright close the doors, and they're looking for the best price on their companies, and these guys they have a very high level of exposure in management that has access to a lot of these different companies, and they're able to put these deals together, and they've passed on many different deals prior, but as we were talking over dinner, they said as this economy continues to falter, they're going to have a little more wiggle room in those deals to be able to, whereas before they may have passed on 100 deals to get to the 70 best deals, but now they're not going to have to pass on 100 of those deals because you're going to see more profitability for people wanting just to run for the exit doors and get out before things get too bad, and they're willing to take less for their companies. So, I mean, all this is going to wind up doing as well as opening up opportunities for another area of the market. And I think so. I think, right. I think it'll open up a lot more for people who are really looking for some above-average returns with very high, very talented people who are in the finance field who are able to evaluate those risks and evaluate those financial models and really come up with some extremely attractive returns for people looking for things that they would otherwise have never been exposed to in the past, and now will be able to be exposed to a much higher variety of different deals. Oh, that's it's going to be an interesting run for sure. But as we're winding down, I want our listeners to know that if you want to get John Dinesh's input, you want to find out more about what he's talking about, go to REOCapitalLLC.com. REOCapitalLLC.com. Find out more about what's going on because, come January, the playing field is going to change. And, again, you're going to have garage sales after garage sales. And I'm not talking about your residential. I'm talking about in the business world.
Right.
And it's going to be a really interesting run. But, John, I want to thank you again for your input on the show and everything. It's always welcome. I'm glad that you're going to be a regular on the show because we continue to talk about everything that's going on with the fiscal cliff and what we're going to be facing in January. So I look forward to having you on the next episode.
Thank you, Lou. Thank you very much. And as things develop, I will do my best to keep you and your listeners apprised of how it's going to impact them and how they at the same time can benefit from that information.
Yeah, well, I think your input is definitely going to benefit them, and I do appreciate it, John. And we'll have you on the next show.
Thanks, Lou, and look forward to it. And I appreciate being a regular on your show.
Excellent. Thank you so much, John. Take care.
You're listening to UCW Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
For lack of a better word, it's good.
You know what I mean? Money to be made in a place like this.
Money never sleeps, pal.
You're crazy.
You know what it takes to sell real estate? It takes brass.